Hello, dividend growth stock investors. Happy Saturday to you. You've got Colby here, the DGI Crab, and you know what time it is? It is Good News Saturday time when it comes to the 60 high quality dividend growth stocks in the DGI Crab portfolio. We've got a major one here for you today. I always like to talk about dividend increases and some good news in the market, and yet another week. We've got a nice streak going here. One of the 60 high quality stocks on this channel has announced a dividend increase, and it is CTAS, the Service Professionals. So CTAS is one of our tier one stocks for the 18 to 30-year-old investor. Then if you're new to the channel, you'll know that of the 60 stocks this channel focuses on, they are separated into four different groupings or tiers based on age. So CTAS is in the tier one group for the 18 to 30-year-old investors because it is a lower upfront yield but high dividend growth stock. So this is one that's going to compound your passive income at a very rapid clip. Now, this is such a great company that I wouldn't blame someone if they were in their 50s and they saw it on a day where it looked like it was undervalued and they wanted to add to it. But if you're doing it at that age, you're not doing it so much for the immediate passive income or to take advantage of the compounding growth. You're probably doing it because you're hoping to flip the shares and get like a quick profit. And while I don't necessarily have any problems with people selling off their shares, the purpose of this channel is to acquire passive income, tax advantage for the long haul that is going to grow year over year over year. And in my opinion, a stock with a low yield like CTAS, which is usually in the 1% range, if that, is much better suited for younger people who have a lot of time that they can allow the massive dividend increases that a company like CTAS typically gives out to compound. So CTAS, you might look at this logo and think that it's pretty familiar, but you're thinking, where have I seen that logo before? So CTAS, they provide a lot of services to businesses. Primarily, you may know them for uniforms. You see CTAS trucks out there running around delivering and picking up uniforms. They also do a lot of cleaning products, bathroom supplies, floor mats, hand sanitizer stations. So a lot of like cleaning and bathroom type supplies that they do for businesses. They have been around since they were founded in the Great Depression, and so they've been around for quite a long time. But they have a 41-year consecutive year streak of increasing the dividend. This is a dividend aristocrat, just one of the absolute best dividend growth stocks out there. Very under the radar company. But look at what they've done here. They have increased their quarterly cash dividend uh, to 156 per share. It used to be 135 a quarter. It's up to 156 now. It is representing a 15.6% increase. So absolutely fantastic increase. This is exactly what we want to see in the tier ones, where we want to buy a collection of stocks over the course of your 18 to 30 years of age, where you're getting a 1 to 2% starting yield collectively. And as a group, we probably want to see at minimum 10% annual dividend growth, but hopefully more like 12 to 13%. And CTAS coming up with this 15.6% banger of an increase has done exactly what we want it to do. And by the way, this was announced back in May, so this was before I had even started this channel, but coming up in September on the 4th, I believe it is, CTAS will be doing a stock split, a 4-to-1 stock split. Now, that's not necessarily going to affect your passive income or the dividend in any way, but a lot of the times, not always, but a lot of the times, you'll see a stock run up in price immediately following a stock split. So we'll have to see if that happens for CTAS. It's been pretty overpriced up to this point in the history of this channel, so it hasn't been one that I've been particularly amped up about buying. But let's take a look at CentOS and the history. So you can see here it trades for $761 a share right now. So a 4-to-1 split will be pretty nice. That's going to bring the share price down below 200 and maybe make it a little bit more appealing to people who just maybe have a mental block around adding shares of stocks that are this high. Now, I trade on Robinhood and SoFi, both of which offer the ability to buy fractional shares. And, you can trade on whatever platform you want. Those are my personal choices. But I don't think that I would ever trade on a platform that didn't allow me to buy fractional shares at this point in time because I just don't want to take the time or make the commitment to pile up $700+ just to buy one share of a company. But if I can throw $25 or $50 or $100, heck, even $5 at a company like CentOS every now and again, if it looks like it's a good deal, and just pick up partial shares, then that's great because we're not worried about share count on this channel. We're just worried about acquiring passive income. So let's just take a quick look at the stock price here on the 10-year history. CentOS share price is up 1,131% over the 5-year history, up 190%. And I always like to go back here and kind of look at the COVID dip. So almost $300, or I guess it was just at about $300 a share. We have the COVID crash. It drops down to 179. And guess what? Once it does the 4-to-1 stock split, that's going to be what the shares are worth moving forward. So if you had bought one share of CentOS back here, let's say in April for about $165, or April 2020 for $165, and just held on to that share, well, when they do their stock split, you're going to have 4 shares. You'll have quadrupled your share count. But from 165, just up steadily and consistently, and especially over the last year, CentOS has just been completely destroying. It is up 47% over the last calendar year, 26% year to date in 2024. And if we look at the dividends, Seeking Alpha sometimes doesn't have the dividend growth streak correct. CentOS does have that 41-year streak, so let's not pay attention to that. Come on, Seeking Alpha, let's get that stuff right. Right now, CentOS only yields 0.82%, and and that annual payout is up now to $6.24 per share, so $1.56 per quarter. They have a 5-year growth rate of 21.37% on that dividend. So 15%, little bit slow based on, or a little low based on their recent standards. If we look at the yield history over the past 10 years, you'll see CentOS is not a high yielding company. You're typically going to get CentOS right around a 1% yield range, and that's assuming you're buying it at a respectable value. Right now, as I said before, I do think this stock looks to be a bit overpriced, but there is a reason for it because it's just such an incredible quality stock that it's just the kind of stock that people like to put their money into. 4-year average yield just a tad under 1% at 0.99, and then we'll take a quick look at the dividend growth. All right, so we can see here the dividend growth. We've got a 19% increase last year, 23.5% in 2022. It says down 3% here in 2021, so I'll take a look and we'll see what's happening there, because it does look like there was a dip, 351 down to 340. So let's see if that streak is a legit streak, because you do see some negatives in here, but I believe that's just because of previous stock splits. And sometimes that can mess up Seeking Alpha. I'd have to go back and check and see what the history is on that. Because if you Google what their actual streak is, just about everywhere you're going to see that they are that they have a streak going. So let's see. So they previously did annual dividend payouts, which I'm not a fan of annual dividend payouts. If I'm being perfectly honest with you, I don't get particularly concerned about monthly necessarily, but I do like to see a quarterly increase. And yeah, it just looks like we have a an annual payout plus a 70-cent special dividend in 2020, and sometimes that messes up Seeking Alpha's um, um, tracking ability, because when you're looking for dividend increases and increased streaks officially, what gets counted is their regular payments, and special dividends sometimes make companies pay out more money in one year and then less in the other if they don't do a special dividend that year. But what we're really looking for is the increased streak of the regular dividend payouts, so that we could see 281, 75, 75 at 95, 95, 95, 95 to 115, 115, 115 to 135, 135, 135 to 156. So yeah, CTAS, very consistent. Very happy that they're paying out quarterly dividends for the last few years and not annual dividends. It makes them that much more appealing to me. And they are the last thing I'll mention here is they're also doing. The board of directors announced that they have approved an additional share buyback program under which the company may buy up to $1 billion worth of CTAS common stock at market prices. So share buybacks, that tends to increase the cost of the stock. A 4-to-1 stock split, that tends to cause the stock price to go up. And a 15.6% increase in the dividend. So 3 for 3 there, CTAS. Great work. If you are a CTAS shareholder, big congratulations to you. This one's got to be one of the big winners in your portfolio if you are a shareholder in CTAS. I would love it if that price had dropped down so I could add to my position, but I don't buy stuff when it's when that 4-year average yield is a lot higher than what it is currently right now, and that's just the case with CTAS. So I'm going to be patient on it and wait. What do you all think? Am I wrong? Would you still be adding shares of CTAS despite the fact it looks a little overvalued based on my metrics? Or are you more in the category of let's wait and see? So let me know what you think about it in the comments below. This is Colby, the DGI Crab. Email me your questions at dgiCrab@yahoo.com. Check the links in the video description below to a video to each of the 4 tiers where I go over all of the 60 individual stocks that made the cut for this channel's coverage, as well as a link to a video on ETFs to invest in based off of your age. We're all about age and time horizon here at DGI Crab, so we want to buy the appropriate stocks for our age. I'm not a licensed professional, so these are just this one crab's opinion, so you always do your own due diligence before you invest in anything. But in my opinion, the most important thing is to have a plan, stick to it, and invest consistently and with confidence. When it comes to dividend growth stock investing, patience and perseverance accomplish all things. See you next time, everyone.